Have you ever wondered why it's so important to start investing as early as possible? Today, we're diving into why the earlier you start, the bigger your financial rewards will be. And trust me, it's life-changing. We'll also explore SIPs, mutual funds, SWPs, and use some calculators to see just how much wealth you can build. Ready to get inspired? Let's go. When you start early, you give your investments the ultimate gift: time. This allows compounding to work its magic. Think of it like planting a seed that grows into a money tree. The longer it grows, the more fruits, returns you reap. SIP, or Systematic Investment Plan, is one of the simplest and smartest ways to invest in mutual funds. You invest a fixed amount every month, and over time, it builds into a significant corpus. The best part? SIPs take the stress out of market timing. Just invest consistently and let time do the heavy lifting. Equity mutual funds are a great place to start as being young. It allows you to take some risks. It could be large cap mutual funds. These funds provide stable and steady returns with low volatility, with lesser percent of returns. It could be in mid cap. These funds can offer higher returns than large cap funds because of their greater growth potential. Mid cap stocks have relatively lower volatility and risk than small cap stocks. Or it could be small cap funds. These funds can offer higher returns than large and mid-cap funds, but they are also more volatile due to the nature of the companies and their size. Risk takers often choose this. It is ideal to split your invests in these three and have a balanced portfolio. Now, let's talk about SWP, or Systematic Withdrawal Plan. This is the opposite of SIP. Instead of investing regularly, you withdraw a fixed amount periodically from your investments. It's a great way to create a steady income stream without depleting your portfolio too quickly. Now, let's see the potential returns using some calculators. In the SIP calculator, let's say you invest 10,000 rupees per month for the next 20 years, expecting an annual return of 18%. You'd end up with an impressive 2 crore rupees in your portfolio. But wait, let's take it up a notch. With a step-up SEP where you increase your investment by 10% every year, the results are astonishing. Your portfolio now doubles to around 4 crore rupees. That's the power of increasing your investments annually. Finally, let's use the SWP calculator. Suppose you've saved 10 crore rupees over 25 years. With an SWP, you could withdraw 10 lakh rupees per month for the next 25 years while your portfolio continues to grow. Isn't that mind-blowing? Starting early is the most critical step you can take toward financial freedom. The earlier you invest, the more time your money has to grow, and the bigger your rewards will be. You don't have to live below your means and save or invest everything. You live only once, so it's equally important to live life and have fun. That's why start early so that you can start with low investments for a getter return. If this video added value to your financial journey, don't forget to like, share, and subscribe.